For 80 years, one currency has ruled the world. The US dollar decides who gets funded, who gets sanctioned, and who stays in the global game. It is not just money. It is power. It can freeze nations out of the financial system. It can shape global markets with a single policy decision. But now China is building a rival network. A rival payment system. A rival digital currency. Not loudly. Not suddenly. But methodically. Is this the beginning of the end for dollar dominance, or just another challenge that falls short? And the real question is whether the world is entering a new era of currencies. Welcome back to DFTW, a place to see the world from a different perspective. Follow the link in the descriptions and the pinned comments to watch all our videos on YouTube. Like and share them with your friends if they are helpful. Today, we discuss how China is challenging the US dollar's dominance through its currency, the RMB. For more than 8 decades, the US dollar has been the center of the global financial system. Almost every country uses it in trade. Most commodities like oil are priced in it. Central banks store it as reserves. Global investors treat US Treasury bonds as the safest asset in the world. The dollar is not just one currency, it is a weapon. When people talk about American influence around the world, they often focus on military strength or technology. But the dollar may be the United States' most powerful tool. Because the dollar dominates global finance, the US can borrow at lower interest rates than other countries. It can impose sanctions that freeze other nations out of the financial system. It can shape global liquidity through the Federal Reserve's decisions. Now China wants a bigger role in that system. Beijing has spent more than a decade preparing to elevate its own currency, the renminbi, also known as the RMB or the Yuan. For years, this effort seemed slow and technical. But global uncertainty, trade tensions, and frustration with dollar dominance have created what Chinese leaders see as an opportunity. China is not necessarily trying to destroy the dollar. It is trying to reduce its dependence on it and build a more multipolar currency system, in which the renminbi plays a much larger role. To understand whether that is realistic, we need to look at how the dollar became dominant, what China is doing, and what obstacles stand in the way. How the dollar became king is a long story. After World War II, the Bretton Woods Agreement established the dollar as the foundation of the global financial order. The US economy was the largest and strongest in the world at that time. The dollar was tied to gold. Other currencies were tied to the dollar. That created stability. Even after the gold link ended in the 1970s, the dollar remained dominant. Why? Because the US had deep, open financial markets, strong institutions, political stability, and the rule of law. Investors trusted that they could freely buy and sell US assets. The US Treasury market became the largest and most liquid bond market in the world. Over time, network effects reinforced this dominance. If everyone else uses dollars, it is easier and cheaper for you to use dollars too. International companies price goods in dollars because that is what buyers expect. Banks hold dollar reserves because global transactions run through dollar systems. Oil is traded in dollars because that is how the system evolved. Today, the dollar still accounts for more than half of global foreign exchange reserves. It is involved in the majority of international transactions. But dominance does not mean permanence. In recent years, cracks have appeared in the dollar-centered system. Trade wars, sanctions, financial weaponization, and political unpredictability have made some countries uncomfortable about relying so heavily on a single currency. When the United States imposes sanctions, it can effectively cut a country off from global finance. Russia experienced this after its special military action in Ukraine 5 years ago. Its access to dollar reserves was restricted. That shocked many governments. Even countries that are not US adversaries started asking a quiet question. What if one day this tool is used against us? At the same time, rising US debt levels and political battles over monetary policy have led some investors to question the long-term stability of the US economy. When confidence weakens, even slightly, alternatives become more interesting. China sees this as a strategic opening. President Xi Jinping has publicly emphasized the need to build a strong, widely used currency for international trade and finance. Chinese officials discuss building a powerful central bank and a financial system capable of shaping global pricing. It is not a short-term project. It is part of a long-term strategy to increase China's economic sovereignty and global influence. Why does reserve currency status matter, then? Being a reserve currency brings major advantages. First, it lowers borrowing costs. Because the world wants dollars, there is constant demand for U.S. government bonds. That keeps interest rates lower than they otherwise would be. Second, it creates geopolitical leverage. If your currency is the main channel for global transactions, you can shape access to that channel. Third, it strengthens domestic financial markets. A reserve currency attracts global capital, increasing liquidity and financial depth. China wants some of these benefits. It also wants protection. If the renminbi becomes widely used, China is less vulnerable to U.S. financial pressure. What has China already done toward that goal? Beijing has not waited for a crisis. It has been laying the groundwork for years. Building its own payment infrastructure is paramount. One key step was the creation of the Cross-Border Interbank Payment System, CIPS. This system allows banks to settle international payments in renminbi without relying entirely on Western-dominated systems. CIPS is still much smaller than the traditional global messaging networks, but it is expanding. More banks from Asia, Africa, the Middle East, and even Europe have joined. The goal is not necessarily to replace existing systems overnight. It is to ensure that China has alternatives. Promoting trade settlement in RMB. China is the world's largest trading nation. That gives it leverage. Beijing has encouraged trading partners to settle transactions directly in renminbi rather than convert them into dollars first. That has grown significantly in recent years. A larger share of China's cross-border trade is now settled in its own currency. Energy deals between China and some suppliers are increasingly denominated in RMB. Russia, under heavy Western sanctions, has dramatically increased its use of the Chinese currency in trade. The more trade flows in renminbi, the more natural it becomes for foreign companies and central banks to hold RMB balances. Currency swap agreements are binding China and other countries more closely in international transactions. South Korea, a traditional U.S. ally, recently renewed its currency swap agreements with Beijing. The People's Bank of China has signed currency swap agreements with dozens of other central banks, including those of South Korea and Japan. These arrangements allow partner countries to access renminbi liquidity directly. It reduces the need to hold large dollar reserves for trade with China. It also strengthens financial ties. China has gradually opened parts of its bond and stock markets to foreign investors. Programs have been created to connect mainland markets with Hong Kong. Foreign institutional investors can access Chinese government bonds more easily than in the past. Chinese government bonds now appear in some major global bond indices. That forces certain international funds to allocate at least some capital to RMB assets. Developing the digital yuan is another step for China to push its currency worldwide. Beijing is also ahead of most major economies in developing a central bank digital currency. The digital yuan has been tested domestically and in limited cross-border trials. The long-term vision is clear. Digital currency could make cross-border payments faster and cheaper, reducing reliance on dollar-based clearing systems. If the digital yuan integrates smoothly into international trade platforms, it could accelerate the use of RMB. China is not acting alone. The BRICS group has openly discussed alternatives to dollar dominance. While a full BRICS currency remains uncertain, the political messaging is clear. Many emerging economies want a financial system that is not centered exclusively on the United States. China presents itself as a stable partner advocating a multipolar currency order. In this vision, the dollar would remain important, but it would share space with the euro, the renminbi, and other currencies like the Japanese yen and the British pound sterling. Despite progress, major barriers remain. China maintains significant capital controls. Money does not flow freely in and out of the country. For global investors, that is a serious limitation. A reserve currency must be easily convertible. Investors need confidence that they can enter and exit positions without political interference. As long as Beijing tightly manages cross-border flows, the renminbi will struggle to match the dollar's flexibility. Financial transparency and rule of law are also concerns. Global investors value predictability. They want transparent institutions, independent courts, and clear legal protections. The United States, despite political drama, still offers deep legal protections for investors, as long as their clients are not from adversary countries. Compared with America's unpredictable POTUS, the U.S. financial system is more transparent. Everyone knows how much money the Fed printed out of thin air. China's system is different. Policy shifts can be sudden. Regulatory crackdowns have occurred across sectors such as technology and real estate. The real estate sector is a good example. Because the Chinese government has actively squeezed the housing bubble over the past several years, foreign capital cannot exit the Chinese real estate market with excessive profits, as it could in other emerging markets. Harvesting in China is not as easy as they looted Argentina. These differences affect confidence. Greedy investors from the West are cautious. China's economy still relies heavily on exports. A very strong currency can make exports more expensive. If the renminbi became a major reserve currency, demand for it would rise. That could push its value higher, potentially conflicting with China's growth strategy. Beijing must balance global ambitions with domestic stability. The dollar's dominance is reinforced by decades of habit, infrastructure, and trust. Oil derivatives, global debt, and central bank reserves are deeply integrated into the dollar system. Replacing that scale would require enormous structural change. Most serious analysts agree that the renminbi is unlikely to replace the dollar outright in the near future. The gap is too large. The dollar still accounts for the majority of global reserves. The renminbi represents only a small percentage. But replacement may not be the goal. Gradual diversification might be. If the renminbi grows from a small share to a moderate share of global reserves, that alone changes global power dynamics. Even a shift from 2% to 10% would be significant. The more realistic scenario is a slow movement toward a more multipolar currency system. In this system, the dollar remains dominant but shares space with other major currencies. Trade in Asia might increasingly use renminbi. Europe might push for a stronger role for the euro. Commodity exporters might diversify reserve holdings. That would not be a dramatic overnight change. It would be incremental. However, several factors could speed up the process. If the United States were to use financial sanctions more aggressively, more countries might seek alternatives. If China further liberalizes its financial system and eases capital controls, global investors would become more comfortable holding RMB assets. If digital currency platforms simplify cross-border renminbi transactions, adoption could increase. And if emerging markets continue to deepen economic ties with China, trade-based RMB usage could expand naturally. On the other hand, financial instability inside China could undermine confidence. A major property crisis, banking stress, or prolonged economic slowdown would discourage reserve diversification into RMB. Political tensions that restrict access to foreign investment would also slow progress. Trust is central to reserve currency status. It takes decades to build, but it can be damaged quickly. The strategic logic behind China's push is diverse. Beijing's strategy is not purely economic. It is geopolitical. By internationalizing the renminbi, Beijing reduces exposure to U.S. financial leverage. It strengthens relationships with developing economies. It increases global influence. It also aligns with China's broader ambition to play a central role in shaping global institutions rather than simply participating in systems designed by others. Even partial success enhances China's autonomy. It is the long game that will not be over in days or weeks. Currency dominance rarely changes quickly. The British pound once dominated global finance. It gradually declined as the United States rose economically and politically. That transition took decades. The same would likely be true of any shift away from dollar dominance. China understands that. Its policies are steady, patient, and strategic. It builds infrastructure. It signs agreements. It promotes trade settlement. It develops digital currency technology. It opens markets cautiously. Each step alone is modest. Together, all steps form a long-term transformation plan. The renminbi is not about to dethrone the dollar. The dollar's advantages in scale, liquidity, legal stability, and global trust remain overwhelming. But the global financial system is evolving. China is positioning itself for a world where economic power is more distributed. By internationalizing the renminbi, it aims to capture a larger share of global finance, reduce vulnerability to U.S. pressure, and increase its geopolitical influence. The most likely outcome is not replacement but coexistence. A future where the dollar remains first among currencies but no longer stands alone. And in global finance, even small shifts in reserve allocation or trade settlement can have big, long-term consequences. China's challenge to the dollar's dominance is neither dramatic nor sudden. It is deliberate, methodical, and long-term. That may be what makes it significant. The next decade will show whether the renminbi becomes a true peer currency or remains a strong regional player. Either way, the era of unquestioned dollar supremacy may slowly be giving way to something more complex. And that complexity could redefine global power in the 21st century.